Picture this. You finally do the responsible thing. You start saving money. Every month you move a little bit into your savings account. $100 here, $200 there. You feel good about it. Responsible, disciplined, financially mature. But then one day you open your banking app and realize something strange. Your savings account has $10,000 sitting there, and it's earning something like 0.5% interest, which means after an entire year, you've made $50. Meanwhile, you keep hearing people talk about investing, stocks, index funds, compound growth, and suddenly you start wondering, wait, am I doing this wrong? Because saving money is good, but saving alone rarely builds real wealth. And this is where a lot of people get stuck. They know saving is important, but they have no idea how to transition from saving to investing. So in this video, we're going to break down the exact step-by-step path to turn saving into investing without feeling overwhelmed or risking your financial security. My name is Jack. If you're someone who has money sitting in savings but isn't sure how to start investing it, make sure to hit the subscribe button and give this video a thumbs up. Let's start with something that might sound controversial. Saving money alone will almost never make you wealthy. Look, saving is important, but it's not the final goal. It's just the first stage. Because here's the thing. Savings protect your money. Investments grow your money. And those are two very different jobs. Let's look at the math for a second. Imagine you save $10,000 in a typical savings account, earning 1% interest. After 1 year, you have $10,100. Not bad. But now let's compare that with investing. Historically, the S&P 500 stock market has returned about 10% per year on average over long periods. If that same $10,000 earned 10% annually, after 1 year you'd have $11,000. Now that difference might not seem huge at first, but here's what most people don't realize. The real magic is compounding over time. After 20 years, savings at 1% equals about $12,200. Investing at 10% equals about $67,000. Same starting money, completely different outcome. And this is where it gets really interesting. The biggest wealth gap isn't usually between people who save and people who spend. It's between people who save and people who invest. But here's the problem. Most people never make that transition. And the reason isn't math. It's psychology. Saving feels safe. Investing feels risky. When your money sits in a savings account, you can see it. It doesn't fluctuate. It doesn't drop 5% in a random Tuesday afternoon. But investments? They move. Sometimes up, sometimes down. And that emotional volatility scares people away. Now you might be thinking, okay, Jack, but I don't want to lose my savings. Totally fair. And that's exactly why the transition from saving to investing should happen in stages. Not all at once. Let's walk through the step-by-step path. Step 1. Build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This money stays in savings. It's not for investing. It's not for opportunities. It's for unexpected problems. Job loss, medical emergencies, car repairs. Because here's what most people don't realize. The biggest reason people panic sell investments is because they need the money too soon. An emergency fund protects your investments from your own life. Step 2. Separate saving from investing mentally. This is huge. Think of saving and investing as two different buckets. Bucket 1, safety money. Bucket 2, growth money. Safety money doesn't move. Growth money is allowed to fluctuate because its job is to grow over time. This mental separation reduces anxiety dramatically. Step 3. Start investing small. Look, a lot of beginners think investing requires thousands of dollars. It doesn't. Many brokerage platforms allow you to start with $50 or $100. The goal isn't massive profits at first. The goal is building the habit, because habits matter more than timing. Step 4. Focus on simple investments first. Here's where beginners often make a mistake. They jump straight into complicated strategies. Day trading, options trading, crypto speculation. But the simplest investments often outperform complicated ones. For example, Index funds. These funds track the overall stock market. Instead of trying to pick winning companies, you're investing in hundreds of companies at once. Diversification, lower risk, long-term growth. It's simple, and it works. In fact, legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most investors. Now here's what most people don't realize. The most powerful investing strategy is actually pretty boring. It's called consistent investing. Let's look at a quick example. Imagine you invest $300 per month into the stock market. If the market averages 8% per year, after 25 years, you'd have roughly $285,000. But here's the crazy part. You only contributed $90,000. The rest, almost $195,000, comes from investment growth. That's compounding working in your favor. But psychology still matters here. Because investing feels uncomfortable at first. Markets go down. News headlines get dramatic. People panic. And this is where discipline separates investors from gamblers. Let me give you a quick analogy. Saving money is like storing seeds in a jar. You're protecting them, but nothing grows. Investing is like planting those seeds in soil. At first, it looks messy. You don't see results immediately, but over time, things grow. And eventually, you have something far bigger than the original seeds. Now you might be thinking, okay, but what if I start investing and the market crashes? Great question. Because market crashes are normal. They've happened dozens of times in history. But here's the key insight. Long-term investors actually benefit from downturns. Because when markets drop, your monthly investments buy more shares at lower prices, which often leads to stronger returns when markets recover. This is why many experienced investors stay calm during market volatility. They're thinking in decades, not days. So let's summarize the step-by-step path. First, build a 3 to 6 month emergency fund. Second, separate your money into safety money and growth money. Third, start investing small amounts consistently. Fourth, focus on simple long-term investments like index funds. And fifth, stay disciplined and give compounding time to work. Because here's the truth most people eventually learn. Saving money gives you stability, but investing gives you freedom. The earlier you combine both, the more powerful your financial future becomes. If this video helped you understand the path from saving to investing, make sure to hit subscribe. And I'm curious about something. Are you currently in the saving stage? Or have you already started investing? Let me know in the comments. Because the moment you transition from saving to investing, that's when your money really starts working for you.